following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp, brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, and everybody, welcome to Options Bootcamp. I just love that theme music. It really gets me in the mood for some options boot camping, to construct our own verbiage for the day, to construct our own new words, our own new terms here on Options Bootcamp. My name is Mark Longo from theoptionsinsider.com and the Options Insider Radio Network. And a quick note, if you like what we talk about on this show today and you like listening to myself and, of course, Mr. Dan Passarelli and a number of other experts from the world of options, and you're interested in perhaps learning a little bit more about unusual options activity, then, my friends, do I have an event for you. It's our first ever Options Insider live event where we're doing it just for you, the listeners and the readers of the Options Insider. So surf on over to theoptionsinsider.com/events and find out more about our unusual activity forum that's going on here in Chicago at the historic CBOE, the home of options trading, the birthplace, if you will, of options trading. It's going to be on March 27th from 2 to 6 p.m. It's going to be a really fantastic event. We're really going to get into the nuts and bolts of unusual activity, what it is, how do you find it, and most importantly, what do you do with it once you find it? So a lot of great information there. We're even going to throw in a floor tour so all of you folks can see the VIX and SPX and what all those things trade, and go check them out before they're gone because, hey, the floors aren't getting any younger, and things are moving upstairs. So once again, if you're interested in learning more about that and seeing me and seeing Mr. Dan and a number of other great experts from the world of options, then surf on over to theoptionsinsider.com/events. We've got some great early bird specials going on right now. If you register, there are only about 100 people can come to this thing. So get on the horn if you're interested. All right, and with that out of the way, allow me to introduce my cohorts, my partners in crime, my fellow drill instructors. Starting off with the man I just mentioned, a.k.a. he of the black hat, none other than good old Dan Passarelli from Market Taker Mentoring. Mr. Dan, welcome back to the show, sir.
Oh, it's a chilly one out here today, Mark.
Yeah, I got some snow on the old training ground today.
Yeah, no kidding. It doesn't look like it's going to stop anytime soon. It's a veritable winter wonderland.
We're recording this right now, right from the heart of downtown Chicago. And as I record this and look out our window here in our scenic Options Insider studios, we have a view of the river here in downtown Chicago, and I cannot see across the river. So that should tell you how much snow is coming down right now. You can't even see all the way to the other side of the river. So there you go. Fun times here in the windy/snowy city. Of course, beaming in from the other side of the earth, a.k.a. New York City, we are joined by the major domo over there at SogoTrade.com. He is none other than Mr. John Critchley. Mr. Critchley, welcome back to the show to you as well, sir.
Hi, Mark. Hi, Dan. I'm in New York City, a balmy 45 degrees and maybe some rain later, but better than snow.
That's veritably tropical in comparison to what we've got going on over here. It truly is a sleet, snow, the whole 9 yards. I guess they're realizing, wait a minute, they haven't gotten much of anything all year, so really let's get them all in one fell swoop out there in Chicago. But enough of the meteorological updates for the Midwest and the Northeast. It's time to get into some options action. It's time to get into some basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Call in. Prepare to learn. Yes, sir.
All right, as the man says, prepare to learn, because it is indeed time for our basic training segment. This is where we walk you, the raw options recruit, through some interesting options basics, some basic concepts, some basic fundamentals, and help you put it all together to incorporate that knowledge into your options trading. And today, John and Dan and I were sitting around thinking, what haven't we hit on? What's a good fundamental building block for new options traders? And it kind of occurred to all of us almost simultaneously. So wait a minute, what about parity? What about synthetics? And synthetics, that's a scary word. Parity, that's a pretty scary word too if you think about it. And if you look up put call parity online, you'll find a lot of equations and a lot of really scary stuff that I think can really overwhelm the novice options trader. But the key to what we're going to talk about today, and the key takeaway you should really get from this, is that when you're looking at an options chain, of course, calls and puts on the options chain, calls on the left, puts on the right. You see a price for one, you look across on the same strike, let's say our favorite name XYZ, the XYZ 100 strike. You look at a price for the calls, and you look across the way and see a price for the puts. You should understand that there is a relationship between those two. They're not just two willy-nilly things. They're not two things where the value of one is arrived at completely independently of the other, and it's really up to the vagaries and the whims of the market maker on that particular day to determine the value of one versus the value of the other. No, those two are fundamentally linked. And what that linkage is called, really, in the business is called put-call parity. And that essentially implies that if you look at the value of a call or the value of a put, it in turn, that price will imply the value of the other option on that same strike. Let's walk through a really basic example. We won't even dive into the equations and everything like that, because that can get it can bury you in a little bit of minutia, and that's not really the point of the show. We really want to walk you through the concepts. So let's talk about that proverbial XYZ 100 everyone likes to talk about. XYZ, let's say XYZ is trading at $101 right now, and you're looking at the XYZ strike. You see the XYZ 100 call, the front month, the call is trading for $1.17. If you look at that, and someone who's familiar with put-call parity will look at that and say, wow, that call has $1 of meat, $1 of intrinsic value in it, because the stock, of course, is trading $1 higher from the strike price of the call. So that gives it $1 of meat. But the stock, the option isn't trading for $1. It's trading for $1.17. So what is all that other stuff in there, all that fluff? Remember, we talked about that on previous shows. That's, of course, extrinsic value. That's your interest, which really, and cost of carry, which really isn't that much of a factor right now. Interest rates are effectively zero for the most part. But you're talking about volatility premium and all these other things that get built into an options price. And that's what we're focusing on for this example, because that is what really implies the value of the put on that same strike. Now remember, the put, the corresponding 100 level put, is worthless from an intrinsic value perspective. There is no meat on those bones. The stock is trading 101. It is trading above the 100 strike price. There is no reason anyone would want to sell the stock at 100 when they could sell it at 101 in the marketplace. So from an intrinsic perspective, that option is worthless. And yet, if you look at the books, it's going to be trading, it's going to have some value all the way into expiration. What is that value? Well, you can instantly infer that just by looking at the price of that call. That call is trading for $1.17. Anyone who's familiar with put call parity will know, wait a minute, let's dial that back, take away the intrinsic value, and just look at the extrinsic value, and that is 17 cents. And that is what is attached onto the value of this call that gives it that extra bit of fluff, that extra bit of premium. That other option on that same strike is only fluff, is only premium, so it's going to equal that same amount of fluff we see on the call. So you can look at that number and say, okay, the call is trading for $1.17. Well, that put's going to be trading for 17 cents. That's just a quick rule of thumb, a quick guideline that you can look at, and you can do this exercise across any option chain, looking at options on the same strike, and do that basic math. Now, things are going to differ a little bit. There could be a few cents off here or there. There are some scenarios, other dividends, other things that are going to throw this all out of whack a little bit, but for the most part, whenever you look at one option on a particular strike, you can turn around and look at the value, subtract out the intrinsic value, and whatever's left over is then going to give you a very good rule of thumb about what the value of the opposite option on that strike is going to be. Now, Dan, I know you have a lot of people coming to you in various levels of expertise, including a lot of beginners, and I'm sure you walk them through put call parity quite extensively. So what do you tell the people who come over to Market Taker Mentoring when they call you up or take your webinar and say, Dan, teach me about put call parity, sir?
Well, the conversation usually goes with me forcing them to learn it against their will, kicking and screaming.
Yeah, it's not the most sexy of topics. I don't think anyone really, I was joking kind of, I don't think anyone really calls you up and says, please, sir, for the love of God, teach me of this parity thing. I must know.
Yeah, well, I tell them, look, it's important. I'll tell you what, here's one of the ways where it really, really comes into play. And from a practical standpoint, it's with just simple replacement strategies. Let's not get crazy and use fancy terms like synthetic relationships. Let's just talk replacement strategies. There are a lot of people out there I talked to probably 20 students over the last couple of years who said, hey, look, I'm looking at buying this stock, but I want some protection, so I'm going to do a married put. I'm going to go out there, I'm going to buy the stock, and at the same time, I'm going to buy the put. I just want to speculate on it going higher, but I want that protection. I said, oh, okay. Well, you must really, really like your broker. I said, well, why? I said, because you are just dying to pay him 2 commissions instead of 1. Because you can have the exact same risk reward by simply buying a call instead of buying stock and buying a put.
John, cover your ears for this part.
Yeah, we like 2 commissions. Come on, Dan.
Oh, I forgot who I'm dealing with here. So, that's the thing is there are these synthetic relationships, or let's just call them replacement strategies, where you can, maybe save a little cash and commissions, no offense again, John, or maybe be able to kind of move in and out of different positions. And we can talk a lot more about that kind of stuff as we go through the show today.
Now, John, obviously, you're also dealing with a wide array of options customers, and I'm sure you've had this conversation many times about the put implying the value of the call and vice versa, and walking them through put call parity. I know one of your favorite concepts is premium over parity. You hit on that quite a bit. So why don't you walk our listeners through what you tell people when they come to SOGO and are learning about these concepts and making some basic beginner mistakes, what you walk them through on these concepts?
Well, one of the things I always bring up is that a common refrain or saying among the professional traders and the market makers is that calls are puts and puts are calls. Now, what do I mean by that? And many people say, how can it not make any difference whether traders are selling puts or selling calls? How are they the exact same thing? Well, the answer is that professionals who provide liquidity, market makers, an option is an option, does not make a difference if it's a call or put if it's hedged. Why is that? If a trader buys calls, he or she has 2 choices. Keep the calls or turn them into synthetics, puts, by selling 100 shares of stock against a long call buy. In this case, the call is turned into a put. That's another way to say the calls are puts. If a trader buys puts, the purchase of 100 shares turns them into calls. It's as simple as that. So I try to tell our customers that try to understand put call parity, but understand that if you hedge your options, and I actually wrote about it in my blog, the use of synthetic options, and I think I'm going to send it over to the Option Insider, this update a little bit, and it goes into the nuts and bolts more of this principle.
And I've done a lot of different options discussions and conversations and presentations over the years on a number of different topics. And one of the most popular ones I do, I get asked to do it quite a bit. In fact, I'll be doing it again tomorrow with Dan and the boys over at Market Taker Mentoring, is one of my favorite topics to discuss. It's the top 5 mistakes of options traders. And one of the key mistakes I outlined, give you a little bit of a preview, is exactly what we're going to talk about next, which is synthetics and the ignorance of or lack of understanding of synthetics, what they are and how they work. John just hit on that notion of calls are puts and puts are calls, and that's true from a professional options trader's perspective. When we first walk on the trading floor, we learn very quickly that essentially units are units. That's what they call them on the floor. If you're long a strike, you're long a strike. If you're short a strike, you're short a strike. Whether it's a put or a call is really immaterial in that conversation. Professional options traders are really looking to focus on volatility, and strikes are really just units to them. And that's how professionals look at it. Retail tend to look at it differently. They look at calls versus puts. They don't understand this basic fundamental relationship. And one of the best ways I show this to people is with the conversation I have with a lot of people who everyone, when they come to the options market, they like to generate income. One of their favorite strategies is time and again the covered call. They turn to it to generate income. They can write it against their existing stock portfolios. This is pretty much the entry-level gateway drug trade for options for a lot of people, if you will. So they start using that. They start learning that trade. They start learning that technology. They start learning that trading strategy, and they like it. And then they start realizing how much income they can generate. Then I'll talk to those same people and say, wow, have you ever thought about selling a short put, a naked short put, as a way to leverage into a long equity position and perhaps collect some premium while you're doing it? And those same people will look at me and their eyes will pop out of their heads and they'll say, no, my God, why would I ever do that? That is ridiculously risky. I'm just a covered call guy. That's safe. I like doing that. I'm just getting a little bit of income on my stock. That's safe. And then what I start doing is I walk them through the basics of synthetics. And I think a quick way to do this too, if you're a listener at home, you can play along with the home game, is type into your browser or your search field, type in a P&L graph, a profit and loss graph for a covered call, and then type a profit and loss graph, a P&L graph, an expiration graph, they're sometimes called, of a naked short put or just a short put. And just put them side by side, and you will quickly see exactly what I'm talking about. The P&L graph of those two are identical. And that's your first indication of what I'm talking about here about synthetics, that exactly these positions are, from a risk perspective, from a Greeks and a lot of other perspectives, are really fundamentally identical. And so once you start understanding those basic relationships, it can really fundamentally transform the way you trade. As Dan just said, why put on 2 positions? Why buy the stock and sell the call when you can just sell the put, and you know that's a risk equivalent trade? So there's a lot of different things we can do with that. I know, Dan, you're a big fan of that married put example. Why don't you walk our listeners through that one as well?
Yeah, that's the most basic synthetics example. The idea is, like Mark kind of alluded to, if you were to draw a profit and loss diagram, and those are pretty basic ways to interpret your risk and kind of visualize it. They would be shaped the exact same way. There's unlimited profit potential to the upside, and there's limited risk to the downside. And in fact, if you were to use the exact same strikes, that is, buy a stock at, call it $50 a share, and buy the 50 strike put, that married put, and compare that against the 50 strike call. Once you were to factor in interest and the potential for future dividends, if it's a dividend-paying stock, the risk, I would argue, would be exactly the same. Now, that being said, there are a few different mechanical differences that come into play which might affect your management, and that becomes a really, really important lesson as well. For example, some traders might exercise a call before the X date of a dividend so that they could receive the dividend. If you exercise a call, then you own the stock and would be entitled to the dividend. If you own a call, then you don't get the dividend. So there's that sort of management tactic. There are some other tactics like, if it's a put, for example. If the put becomes very deep in the money, you might decide to exercise the put to avoid paying interest on holding that long stock and instead go and buy the call. So there's an example where someone would swap out of the married put in favor of the synthetically identical position, the long call, because it ends up being a little bit cheaper. So, this idea of put call parity and synthetics, it's one of those kind of option nerd things that you only hear talked about on shows like this, but I'll tell you what, the people who really understand those synthetics, they have an inherent advantage over everybody else who doesn't, because they can trade better. You know, they end up paying less in terms of interest sometimes, making more in terms of dividends. There's margin issues. You know, buying a call ties up way less margin than a married put with standard Reg T margining. So, you know, it's just like anything else. If you want to be really, really good at your profession or hobby, whatever you want to look at trading, the more you know about it, the better. And put call parity and synthetics, you get some mileage out of that.
Yeah, it's really the most efficient way to go about trading, because if you understand synthetics, if you understand put call parity and these relationships, then you can instantly look at any given scenario and say, well, okay, that is actually not the best way to exploit that situation. I'm going to use this technique instead because it is much more favorable from a risk perspective. It may be equivalent to what I was thinking about doing, but it involves far fewer contracts, and it maximizes my margin and maximizes my Greeks and maximizes everything else. It reduces my commissions. Again, cover your ears, John. So if you understand these relationships, it allows you to quickly intuit the risk equivalency of a position and what the most efficient way to trade that position really is. Now, John, you just mentioned some of these scenarios you walk newcomers to SOGO trade through. What are some other things you tell them when they start to learn about these concepts and they start to become aware of things like synthetics?
Well, when I start talking about synthetics with the customers, the question always arises, why? Why would I ever use a synthetic when I can just buy the call or buy the put or do the underlying? And the reason is there are two reasons. The one is liquidity. I mean, there may be cases where there's more liquidity and tighter spread in the call options than the put options. And this is not uncommon in times of extreme stress and high implied volatility in the marketplace. The customer is able then to get a better price by doing a synthetic trade. It may cost more in margin, but if it's usually a larger customer, the more educated customers are the ones asking these questions. And the second reason is that the pros use synthetic options to help disguise the intention or bias of a trade. Why not the retail customer? Now, this was much more prevalent back in the 80s and 90s, where you could read order flow as a trader. But now, with the use of synthetics, it's much harder to read order flow or the intention of a trade. So if you want to help disguise the intention of a trade, if you're a big option customer and you're trading on options, you might want to do that. So there are two reasons that I give my customers, why you may consider doing these synthetic options.
I was just thinking about it, and in some different scenarios, you may want to implement those. And a common scenario I think that would be very applicable for the listeners of this show is, let's say you're long a call, and you bought that call because you obviously have a fundamentally bullish opinion on a particular underlying. Then the trade starts going against you, and you look at it and you say, wait a minute, I think this is the wrong position to have on. I think I'm going to go get bearish this stock instead. I'm going to buy a put. So that means you have to turn around, you have to sell out the call, close that position, and then buy a put position. So that's a lengthy two-step process. It could take you some time, in which case you may miss a movement in the stock. It's going to generate obviously more commissions. It's going to be a very involved and expensive process to close that out and reverse it essentially. Now, if you have knowledge of these synthetics that we're talking about and these put call parity relationships, you can also say to yourself, wait a minute, I can keep this long call on and just short the stock. And I know that a long call and a short stock position are the equivalent from a risk and a parity perspective of a long put position. And so once you wrap your head around those basic equivalencies, you can easily do these trades to get in and out of positions and reverse positions sometimes in a much more effective and a much more efficient manner. So that's why we really are stressing this on this show. And again, there are some equations involved in this. We're not really going to walk you through the put call parity equation. If you want that, indeed, you can find that on the Options Insider. You can talk to guys like Dan or John, or you can just search put call parity in Google. You'll find more than your share of equations. The reason we didn't want to bring that up is because interest and dividends are a key component of that equation, and those are really not factors right now. And also, in general, it's kind of a bit overwhelming to newcomers when you first put that entire put-call parity equation and then you start wrapping it around. But if you look at that equation very quickly, you chop off things like interest and dividends because they're not really that fundamental right now. You can really look at two basic sides of the equation. If you have some basic fundamental algebra knowledge, you can easily move those two around and you start seeing very quickly what a call is synthetically equal to, what a put is synthetically equal, what a short put is synthetically equal to versus a short call, and vice versa. And you spend a few minutes doing that, and you'll quickly see in your head exactly what we're talking about here. And if you want further explanation of that, then by all means, look at the expiration graphs, the profit and loss graphs for these various positions, like a short put, like a long call, things like that, and you'll start to see exactly what we're talking about here, how these positions are from a risk and from a profit and everything, pretty much from every other perspective, they are fundamentally identical. So once you wrap that around your head, you can easily become a much more efficient and profitable trader.
Mark, can I just add one thing real quick? The example you gave is a wonderful example. The only thing I will caution is that if you're long call and you want to short the stock, some platforms, if you have portfolio margining, that will the program or the margining calculations will pick it up. But on some of the simple Reg T type of regulations, it may not factor that short stock in their long call, knowing that you're only synthetic put. But again, the bigger accounts and larger accounts that have portfolio margining, of course, is going to pick it up. But for the retail Reg T strategy-based requirements, some platforms don't always pick it up. I just want to let our customers know that.
Yeah, that's a good point, and that's certainly one we'll get to on our next show, which will be all about margin and all the fun different intricacies of margining different positions. But for right now, I wanted to throw that example out there. Of course, John is right. If you are going to do that trade, check with your broker, because maybe from a margin perspective, it may be more efficient to have to close it out and put on the put. But for a quick example of how that could really impact your trading, that is a great one. And now, the other real way you can use synthetics to improve your trading is from a risk management and from a trade management perspective. And I know, Dan, that's where the rubber really meets the road for a lot of traders. I know you spend a lot of time with your mentees and your clients walking them through not just how to put on a trade and how to take it off, but really what goes on in between. And synthetics and put-call parity can really play a big part in that.
One of the places where it really plays a very big role is in vertical spreads. A lot of times I'll give a presentation either on a credit spread or on a debit spread. And, the only reason I ever do this, by the way, is simply to amuse myself.
You are very easily amused. We've known that for a long time.
Yes. I will go into the room and, I'll say, hey, how you doing? Blah, blah, blah. And I'll kick it off and I'll say, what's better, debit spreads or credit spreads? And there is like this line drawn down the middle of the room and people have strong opinions. Well, clearly credit spreads are better than debit spreads, or, debit spreads, of course, are better than credit spreads, and I'm not kidding. People really have strong opinions, and especially in the credit spread camp, Premium sellers are very proud to be premium sellers.
Yes, those dark side guys tend to band together. They're very, very vocal about their chosen profession.
Yes. And then, so that part I just do to amuse myself. Because what I used to do, and I kind of stopped carrying this out because it just doesn't work, is I would say, well, it's funny because you would be surprised to know that debit spreads and credit spreads are actually synthetically identical. They're the same thing. And that generally would lead to an argument with one or more people in the room, because how can a debit spread and a credit spread be the same thing, you crazy man?
I imagine that would take up the bulk of your time and you wouldn't get to anything else.
Right. So I just stop, I ask the question and I kind of, giggle on the inside and move on. But the fact of the matter is that debit spreads and credit spreads are the same darn thing. They really are. And that plays a part when it comes to management. So here's the thing. So I just laid out the case, and Mark laid out the case as well, for the idea that if you buy stock and buy a put, that's the same thing as having bought a call. And the opposite then logically must carry, right? If you sell a put and sell stock, that logically, clearly, must be the same as having sold a call, right? Okay, so let's just work this with a debit spread. And, if we had a whiteboard here, this might be a little bit easier to do, but you guys are all smart. You're option traders. Work with me. Visualize this. Imagine I buy a put spread. Say I buy the 50 puts and I sell the 45 puts. But I want to turn each of those puts into a synthetic call, right? So I'm long the 50 puts, so I buy 100 shares of stock. And I'm short the 45 puts, so I short 100 shares of stock. That would be then the same as synthetically being long the 50 calls and short the 45 calls. Now, the fact of the matter is I don't have to buy 100 shares and sell 100 shares. It's just a wash. I don't actually even have to make that transaction. So logically, being long the 50-45 put spread is the exact same thing as being short the 50-45 call spread from a synthetic standpoint. I mean, that's what we've been talking about here at the same time. That's how it works. So here's how that plays into some tactical stuff and some management stuff. One, typically out of the money options have tighter bid-ask spreads. Now, I was kind of talking about commissions and stuff before. Commissions is probably your smallest transaction cost. That's the one to worry about the least. Your biggest transaction cost is probably the bid-ask spread. So if you're deciding, well, should I do, this debit call spread or this credit put spread, which one should I do? This in the money call spread or this out of the money put spread? You would do the out of the money because out of the money has tighter markets, therefore you give up less to the market makers. And then tactically, for those of you who trade debit spreads, a lot of times you trade those out of the money. And if the stock rises above your call, both of your call strikes, assuming it's a call debit spread, and that call credit or that call debit spread ends up being in the money, it functions exactly like a put credit spread. So you don't have to do anything different except think a little bit differently. You don't really, once a debit spread becomes in the money, you stop thinking about it as a debit spread and start thinking about it as a credit spread because synthetically that's what it acts like.
We just blew everyone's minds out there in the listening audience. A lot of these people, and you're right, these people have these fundamental adherents, either they're premium sellers or they're premium buyers, and they tend to fall in one camp or the other. And trying to get them to understand and come to terms and realize that they're not really so different as they thought, and they're really doing the exact same thing just from different sides of the fence. A, it blows their minds. B, they're somewhat resistant to it. And quite frankly, it's a great example to walk through people, but people still, even when they hear that, they say, well, I'm still going to choose the credit spread because I'm collecting. That you can walk them through all the other examples of maybe how it might be more efficient to do the synthetic equivalent and actually buy the trade because you're getting better execution costs and transactions, maybe a little bit better liquidity, whatever the case may be. But they'll look at that and say, okay, I understand all that. I'm still going to sell because I want to collect. It's just some people are just wired that way, and you can't turn them from the dark side as much as you may want to try, dear Dan.
Yep.
So that's kind of our overview of put call parity and synthetics. Again, we took a 10,000 foot perspective here. We didn't really want to A, terrify you, and B, overwhelm you with a lot of equations because it's kind of hard to walk through equations on an audio program. And also, it's not exactly the most scintillating listening. But I think you get the gist of what we're talking about. Of course, if you want more information about any of these topics, put call parity, synthetics, you can, of course, find it on the optionsinsider.com. You can contact Dan, the guys over there at Market Taker Mentoring. And I know John and the boys over there at Sogo and ladies will be happy to walk you through a number of different examples of how you can utilize these strategies on their platform over there at sogotrade.com. John, before we wrap it up here with synthetics and call put parity, anything you want to leave our listeners with before we roll on into the mail call segment?
No, I just wanted to compliment Dan. I think that was an excellent example, and it just goes to reemphasize everything that I say and that Mark and Dan say is that, understand the put call parity and just understand the principle of, again, what Dan said, but that calls are puts and puts are calls. And use that to your advantage exactly how Dan said. Look at the tighter markets, and again, and that way you be giving up, less V or less edge than a wider market. If you have the capital, try to do synthetic, and you can, the commissions at Sogo Trade are so low for to do equity. It's only $3 for an equity trade, so the commissions won't be that factor. If you have the capital, look for the tighter spread to execute either the credit spread or debit spread in your favor, and you're definitely going to be saving money in the long run.
Sure, compliment Dan, why don't you? I'll remember that the next time you're complaining about not being called Major Domo. I'm going to keep that in mind there, sir. All right, and with that slight, we're going to roll right on into the mail call segment.
Mail call. Time to look at questions submitted by our listeners.
All right, and welcome to the mail call. This is, of course, the portion of the show where we give you, the listener, the chance to sound off and join us here on the Options Bootcamp show. And first up, we have a question from EonJ. And he asks, does portfolio margin matter if I am just trading long verticals and ratio spreads? And this is a bit of a prelude of what we're going to get into on our next show. But I know John and the boys over at Sogo are really, really excited to talk about margin. So we're going to get one question in this week. So John, this sounds like this is right up your alley, sir. Lay out the mysteries of portfolio margin as it applies to these strategies for Mr. EonJ.
Well, the first thing I want to say is that a portfolio margin is not just for trading long verticals and ratio spreads. It applies to naked positions, and it applies to other positions as well. But remember what portfolio margining is. It is a margin that is based on the risk of the position rather than the fixed percentage of Reg T or strategy-based margin. You know, if you do a ratio spread like EonJ says, the portfolio margin is going to give you better margining just simply because with regular Reg T, you're going to pay for the long vertical, okay, and then you're going to have the margin for the naked short side. Portfolio margin will take into consideration that you will make some money if the stock rises to your short. As it breaks through the short, your margin will go higher. So portfolio margining takes that into consideration. Remember what we said in the last show, that portfolio margining takes into consideration, up or down, let's say 10% move with implied volatility up a certain percentage. And if you have enough equity to cover wherever you have the most risk, then you can trade. So portfolio margining for larger customers, and this is why the traders and the liquidity providers have portfolio margin, is definitely the way to go.
In general, EonJ, portfolio margin is just a preferable way to go as opposed to Reg T. In the strategies you outline, it's not particularly relevant, more so in the ratio spreads, because then you have, of course, as John said, you have that naked short component, and that's where something like portfolio margin would be a little bit more effective. But just in general, if you have portfolio margin, no matter what strategies you're doing, it's usually going to be a much more efficient and effective way to allocate your capital. Now, that said, if you just have a small account, $25,000, $35,000, it's not worth, and you're just doing verticals and a little bit of ratio spreads, it's not worth putting all your money in the account and get it up over 100,000 or perhaps even more in the cases of some brokerage accounts just to qualify for a portfolio margin. But if you're close to that threshold anyway, or if you have more than that threshold in your account and you haven't applied or asked for portfolio margin treatment, then you definitely should be doing it, because it is just, in general, as you expand your options trading, it will make it much more capital efficient to do so. Next up, Dan, you're going to like this one. This is a question from Phil S. writing to us out of Santa Fe, New Mexico. This touches on what we were just talking about, credit spreads and debit spreads, and a little bit in between. He asks, I attended an options seminar recently where they promoted the selling of credit spreads in Apple and Google. Why am I not surprised? That seems to be just the de rigueur thing to be doing in the options business these days. If you're doing an options seminar, you're telling people to sell credit spreads in Apple, regardless of the risk or the danger or the capital required to actually do so. All right, Mr. Phil goes on to say, I'm still somewhat unclear on the concept, however. What exactly is a credit spread, and how does it differ from other spreads like straddles, call spreads, etc.? Thank you for your time. I just discovered your program. I'm looking forward to listening to your earlier episodes. Well, Mr. Phil S. from Santa Fe, I certainly encourage you to go back and listen to those earlier episodes, because we outlined some of those exact concepts that you ask. In your question, you kind of really raised two separate and distinct issues. Maybe I'll hit the second part first, and I'll let Dan go into the credit spread thing again. It was the first part, or the second part, you asked, does a credit spread differ from other spreads like straddles and call spreads? You're kind of mixing apples and oranges there. There are strategies, which are straddles. There are call spreads, verticals, different things things like that. And then there are different ways to essentially go about those strategies, buying or selling them. And that's where we get into the debit versus credit spread side of the equation. So you could have a credit straddle, you can have a debit straddle. There's many different flavors of those. So you shouldn't think of them as being either a credit spread or a straddle, or either a credit spread or a call spread, because you could indeed have both, or have a debit spread and a call spread. They're really not, they're two different ways of going about the same thing. Mr. Dan, anything you'd like to add to that?
Yeah, so let me go with the first part of the question on exactly what is a credit spread. Credit spreads are pretty versatile strategies. They're typically traded where both options are out of the money, which is in the context of the whole discussion here today. And when the options are out of the money, you sell the option that's closest to the current stock price. You sell the option with the strike price that's closest to the current stock price. So, for example, if it's a call credit spread, if the stock's trading about 50, maybe you would sell the 50 calls and buy the 60 calls. If it's a put spread and the stock's at 50, maybe you'd buy the 45 puts maybe you'd sell the 45 puts and buy the 40 puts. It's called a credit spread because you take in a credit when you initially make the trade. Now, that's not a profit. That's just you're basically shorting the spread, and then later you have the intent of buying it back or watching it expire worthless. And the whole objective is that as time passes, if the spread remains out of the money, time decay works in your favor. The spread gets worth less, which is what you want it to do, and it can lead to profit. So credit spreads are very, very versatile strategies. You can kind of cobble them together into other things like iron condors and some of these other some of these other strategies. And I like them. I trade a lot of credit spreads.
So after that whole discussion of credit versus debit spreads, you show your true colors, sir. It doesn't matter. I love credit spreads.
That's because they're out of the money.
There you go. So there you go, Mr. Phil asks two very separate things: credit versus debit spreads, a way of executing your straddles, your call spreads, your other type of strategies and spreads. So go back and listen to our old episodes, Mr. Phil, and these concepts will become much clearer for you as you start to go through those episodes. Next up, we have a question from a lot of J's today. Ephraim J. He says, I'm a CFP and I'm starting to add options to my asset mix. So first off, Ephraim, let me say congratulations to you. That's if you're taking that step, you're ahead of the game and you're ahead of many of the others in your profession. So we're glad we've lured you to the proverbial dark side. Mr. Ephraim goes on to say, does SogoTrade offer a platform and or specialized tools for institutional/advisor customers? Mr. John, this one sounds like it's right up your alley, so take it away, sir.
Yes, I recently went to the New York Traders Expo. I spoke to the head of the OIC, which is the Options Industry Council, and he mentioned, which we all know, the explosion in asset managers and CFPs using options and discovering their flexibility. At SogoTrade, we understand that. We realize that we're targeting that. We recently launched an advanced screener that we white label, and what makes this screener unique to the other more plain vanilla screeners you'll see out there is that this screener uses a algorithm that uses a mix of fundamental analysis along with technical analysis to generate the equity rankings. You choose the parameters you want: the stock rating, the sector rating, the technical condition, the volume range, etc. And then the algorithm will spit out the best stock for your chosen criteria. It's a very cool and useful tool, and it allows our customers, equity and options, to greatly benefit and to get some ideas. And we're very excited about that. We also have a new platform in beta testing called Sogo Elite, and it's a very sophisticated options and equity platform with advanced charting. I'm not a chartist by trade. I'm more fundamentally based, but for the chartists out there, when this comes out, it's going to be really exciting. And for our real high frequency guys and black box traders, we have a platform called Laser, which is an excellent platform for all that stuff. So we have it pretty well covered right now, and we're looking to certainly expand into that business.
John, I always knew you were a diehard fundamentalist. I could just tell.
Always.
It sounds good. Sogo Elite sounds particularly interesting. I'll have to check that one out.
Yeah, I mean, the thing is, again, we have a lot of customers that have asked for, more advanced charting. And so we, developed, or, we're going to white label a new platform that has all these different studies and all these crazy razzmatazz technical analysis stuff. And if you're a customer and, you want to use that, go check it out. It's not launched yet. It's going to be launched probably in the next quarter or so. And I'll make sure that, our listeners, aware of that.
Great. We're looking forward to it. And I, of course, say that before as a diehard fundamentalist myself. I'm not really a technical analysis man myself either. So the two of us can be fundamentalists together there, John. All right. Next up, we have a question from, you got to love these Twitter handles, Tim409. He says, what is meant by a, quote, stock replacement strategy? And in spite of your handle, Tim, that is actually a great question. It's a very, very useful strategy, I think, for a lot of listeners of this show. It will come in very handy. A lot of you coming to the show are equity traders. You trade typically long equity positions. But frequently you look at a stock, Apple being a prime example, but there are many others out there that start to get a little expensive. They're $50, $100, a couple $100. You start to say to yourself, wow, why do I really want to allocate all that capital just to buy and hold this stock for X period of time? Even if you do it on margin, you still have to put down 50% of the stock. If the stock is trading north of $100, that could get pretty pricey relatively quickly. So what we talk about with the stock replacement strategy is starting to look at the options chain as a way to do exactly what we've been talking about all this entire show. Allocate your capital much more effectively. And that same, let's say in that same proverbial example, you have XYZ stock. XYZ stock is trading for $100. And if you want to buy 100 shares, that's $10,000 out of your pocket, and you have to put that down and hold that. If you want to buy it on margin, that's still $5,000 that you're tying up to buy that stock. Now let's look at an in-the-money call. Let's say the 70 call that's trading a year out is trading for, let's say, $35. Then you know that if you want to buy the same equivalent position for 100 shares, now you can turn around and just buy that one call. That's going to give you a year's position for the equivalent outlay of $3,500. So now you have a position that is fundamentally a very near to 100 delta position. It's obviously not 100 delta because it's a call and there still is some time left to expiration, but for all intents and purposes, it's a 99 delta option that you've just purchased. So essentially, you've purchased the equivalent to the underlying for a little over a year, whatever the time frame of that option is, for the equivalent price of $3,500. So less even than if you bought the stock on margin. And that's just a quick example off the top of my head. If you start looking at a number of different stocks out there, and it doesn't have to be even that expensive stocks. You can do this with $10 and $15 stocks if you find some really cheap replacement strategies you can do in that as well. And once you start learning this strategy and learning how to implement it effectively, it really can be a great way to go through all of your underlying positions and say, okay, I can replace this with this call, I can replace this with this strategy. And once you start learning that and starting to implement that effectively, you'll be amazed how much more effectively and efficiently you can allocate your own trading capital. Mr. Dan, Mr. John, are you guys big fans of stock replacement trades?
Under the right set of circumstances, people need to appreciate exactly what they are. A lot of times people think, well, instead of buying the stock, I can buy a call and sell a put at the same strike because, I get synthetics and it costs me nothing. But it doesn't really cost you nothing, because the cost of the trade, that's just the capital that's debited or credited. Your broker is still going to ask you to put a margin naturally. So even though it's a zero cost in the scenario I'm describing here, it doesn't cost you zero.
The only thing I wanted to mention about this is I'm actually a very, very big fan of stock replacement strategies. And Mark gave a great description of it. If you want to see how much, because how much you're paying for this right, look at and we talked about this earlier, look at the price of the puts. And the price of puts are a nickel, a dime, or a few cents, or 10 cents. And you can buy that call option, mid-market, a little bit above. Just look at how much over parity you're paying. And that's how much you're kind of giving away, which might not be that much, but again, you're giving away a little bit. And the stock should go on a one-by-one basis on the upside, and they're going to be protected if the stock crashes through, your long call.
Yeah, they really are very efficient strategies. And Dan is, of course, correct. If you put on a synthetic at a particular strike, it's not exactly like you have a free trade. You really just have initiated a position from that strike, and wherever it moves, you'll be debited or credited appropriately. But it's an interesting strategy nonetheless, and certainly for a lot of you out there who are carrying a lot of underlying in your positions and really are tying up a lot of capital, carrying a lot of stock for really no good reason, there are better ways to take some of that money off the table and perhaps put it to work on other things. Remember, there's opportunity cost to everything you're doing. If you're tying up a lot of capital owning stock and carrying stock, then you're missing out on other trades that you simply don't have the capital to do. So these things, simple things like stock replacement, if you go through and you have 10 different underlying positions and you can find effective ways to swap the stock with a long call or synthetic, then you really are going to put your capital to work much more effectively. So great question there, Mr. Tim 409. All right, and thank you to all of you who wrote in and joined us today on our mail call segment. We, of course, encourage all of you to join your fellow listeners and sound off on the mail call segment. Just surf on over to theoptionsinsider.com. You can post a comment on our site. You can shoot us an email via our comment system. You can, of course, shoot us an email directly, questions@theoptionsinsider.com. Just please put question for Options Bootcamp in the subject line so we know which show you're referring to. Of course, you can find us on Twitter. We're just at Options, or on Facebook, look for Options Insider. A lot of great ways to reach out to us and get your voice heard on the mail call segment. But unfortunately, that's all the time we have for this episode. We're going to have to wrap it up. But before we go, one final quick thing. I like to check in with both of my cohorts, my partners in crime, to see what's going on in their respective necks of the woods that may interest you, the Options Bootcamp listener. John, you just gave us a mouthful of things that are either happening now or in the works over there at Sogo. Anything else you want to hit on? Maybe you want to touch on those platforms again one more time.
Well, the one thing I wanted to mention was that, we have a new blog out there that I write, and it's under education pre-login. And this advanced screener, right now we're putting it on the pre-login. So if you are not a Sogo Trade customer and if you go pre-login and go into education, you'll see advanced stock screener. You can even try it out free, try it for yourself. And at some point we're going to put it, post-login. But for right now, it's free to anybody to use. Check out. And the same thing with the blog. Under education, you can read. I do some writing there, and I'm actually going to send a few more articles over to the Option Insider about synthetics that I've written, and that should be good. I'm also on Twitter and Facebook and all those other cool things.
All those great, cool things. Where can they find you on Twitter if they're looking for Sogo Trade?
We have Sogo Trade Option is the one that I write. We also have Sogo Trader and just plain Sogo Trade. So 3 different places. And we also have this new website that, again, pre-login, that has a lot of great new educational content and everything else.
Great. So look for John on all those various platforms. And speaking of various platforms, if you want to check out Mr. Passarelli, he has a new show on our Options Insider Radio Network. It's called the Options News Rundown. So if you want your daily fix of all of the most important, the most relevant, the hottest news from the world of options, then check that out every day on iTunes, on our website, theoptionsinsider.com. I'm sure you'll be able to find it shortly on Market Taker Mentoring or on wherever you get your audio programming, Stitcher, TuneIn, AHA, all kinds of places you can find the Options Insider Radio Network and our newest show, the Options News Rundown. And in addition to expanding your radio stardom, what is going on over there in the land of Market Taker Mentoring? Mr. Dan.
Boy, oh boy, Mark, it is busy over here. One of the things we're doing is we're talking about our newsletter, the Market Taker Edge Options Newsletter, which gives you news for the coming week, the things that all the professional traders are looking at, an educational article, and best of all, 3 actionable option trade ideas every Monday in your email inbox like clockwork. So visit markettaker.com and you can actually take a free 2-week trial of my newsletter there.
Maybe you can even talk about synthetics or stock replacements. There you go. Leverage what we're talking about right here today, listeners.
Indeed.
So subscribe to that and you can find out for yourself if Dan puts his knowledge from this show to work in a future newsletter. All right, and before we go, just one more quick reminder that we do have our Unusual Activity Forum coming up in Chicago on March 27th. So if you're going to be in the Chicagoland area and you're really excited about learning more about unusual activity and you're not tired of listening to guys like myself and Dan and a number of others, then join us there at the CBOE March 27th. You can find out more about that at theoptionsinsider.com/events. Get there and register before all the seats are gone. And of course, we want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this program and making it such a hit on iTunes and elsewhere. And we'll see you next time right here on Options Bootcamp.
Options Bootcamp is brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.